G'day everyone, welcome to the weekend journal update for the 4th of August. Another very strong week in the US that we've just seen, and it certainly looks like the market's taking off again. So things still pretty positive all around the world, and we may have a few more weeks of very good trading and investing ahead of us. So let's have a look at the summary of what happened in the last week. First of all, the S&P ended up rising 19 points on the week, so we've had a series of positive moves. I thought we may have been close to a pullback, but it appears that the market's off again. So no retracement, and really what's driving this, yes, the earnings season has been pretty solid, but what's really behind this is that Fed policy continues to basically reinforce the rally that we're seeing, and there's two reasons I think that there is little chance of any tapering of QE3, in other words a progressive winding back of the money printing. The first one is that the US economic growth is slower than what was anticipated to be the case by this stage of the cycle, and secondly that Bernanke said all along that unemployment rate needed to get down to 6.5% before he would start backing off. Well, in fact, something that hasn't been reported to any great extent is that he's now lowered that hurdle to 6% from 6.5%, which means it's going to be even harder and longer to get down to that level. Plus the US economic growth is really just not strong enough to bring that jobless rate down. So the way that I look at it, it's pretty hard to see that they're going to get down to that 6% level anytime soon. I think it's a couple of years away. And while ever the Fed is continuing to print money, then we're not going to see any major reversal in the stock market. Yes, we'll see the normal 5, 6, 7% kind of pullbacks periodically, but I don't think we're going to see any 10s and 20s and 25% retracements unless the market goes absolutely ballistic and we get some sort of climatic top. However, I do expect a pullback before year end. September, early October is often the period to look for. So yeah, I do expect something before year end. If we happen to get a short-term surge in the market, in other words, if the US market really took off and went up 50, 60 points in a week or two, then I would be pretty wary about that. The other key thing that I'm looking at is interest rates in the US. The 30-year interest rate yield on the 30-year bond is critical, and I'll show you why now. So first of all, let's look at the S&P index. So we had a retracement during June, which is normal. We got a reasonable way ahead of the moving average, the red line. So we got a pullback, that was all perfectly normal, and then it took off again. We reached this level here about 10 days ago. Again, the index considerably above the moving average. Coming into the second half of earnings season, it made sense that this would pull back. However, you can see what happened here. All we got was about 5 or 6 days where the market went sideways, and then on Thursday and Friday, after Bernanke's comments during the week, the market took off again. So it's all-time highs, there's no resistance up here. The index is well above the moving average, but the way that it's looking, I think we could be looking for a continuation of this rally for a few weeks yet. I'll come back to that point in terms of how this proceeds. If it shoots up really rapidly, that would not be a good sign, and it would make the market very vulnerable to a sharp pullback. But if it just progressively moves higher, as it has been doing, with the odd little pause of a few days or a week, as we've just seen in the last little period, then this is sustainable for a longer period yet. Now let's have a look at the Russell 2000. As you know, I've been watching this very closely, and again, it's the same pattern. There's no sign at all that this rally is lessening in breadth. The smaller stocks are not rolling over, so I just do not see an end to this rally at this point in time. But as I said, a couple of things would concern me. One would be that the US index really takes off and puts on a sudden spurt of 50, 60, 70 points in the next couple of weeks. And the other thing that would concern me is this US 30-year bond interest. So this is effectively the interest rate that feeds into mortgages. Now you can see if we pan back here that we've been in a huge band for quite some time between 2.5% and about 3.5%. There's been a big surge since May, and that's taken us to new medium-term highs above 3.5%, and the interest rate got to almost 3.8%. Now you can see on Friday it rolled over. If this continues on towards 4.5–5%, then I've got to conclude that US stocks are significantly overvalued and would be very vulnerable to a fall. So I wouldn't want to see this go any higher. I want to see this maybe pull back and retest around the 3.5% mark. So you can see we got the start of that on Friday night. If this continues back down to 3.5% and then just stays in this range between 3.5% and 4%, then the stock market rally is sustainable. If this gets above 4% and starts heading towards 4.5% and 5%, then look out, we're going to see a significant correction in the stock market, I believe. So there are a couple of signposts to look for. Now let's take a look at the Australian market. The ASX 200 had a good week, rose 115 points. Friday was the strongest day, closed right on the highs, but the best large cap performers were BHP and Rio. They've certainly been outperforming the banks. The banks are still doing well, but BHP and Rio doing even better. So this rotation that I've been talking about now for several months from the safer yield stocks into growth and resources, it's still continuing. At this stage, it's as you would normally expect, it's largely with the bigger companies, and as people get more and more comfortable with the rally in the market, the rise in the resource stock starts to filter down to the smaller ones, and we're just seeing some of the smaller speculative stocks just seeing a little bit of buying interest at this stage. But look, there's still great gains in selected small caps, and that's largely non-resource stocks, and there's been some terrific gains this year. So let's have a look at the Aussie market. So we'll look just at the ASX 200. So this is being driven largely by the banks, BHP and Rio, and you can see big day on Friday. That index is now overbought in the short term, but there is quite a strong uptrend there. So the overseas hedge fund selling that we saw back in June when the Australian dollar was falling, and the Australian dollar is still falling, by the way. So it would appear that the overseas hedge funds have withdrawn the money that they want to, and that further falls in the Australian dollar are not being met with increased levels of selling. So that's an interesting development. Now let's turn to gold. Not a good week for gold. Fell back $44 on the week, and the GDX index also pulled back as well. So it's still in basing pattern. It may take another month, but I think we'll certainly see a move in gold now, and gold stocks. I'm pretty sure we've seen the bottom, and gold stocks will certainly, if we get a correction in September, then gold stocks will be certainly one of the first ones out of that correction. Now copper was steady at $3.16, so not a lot of change in copper. Oil also steady, but comfortably above $100 a barrel. The instability in the Middle East, of course, is contributing to that. And there's the 6-month chart on copper. Let's just go back and have a quick look at gold. This is gold on a weekly basis. So you can see we had a good couple of days up. A good couple of weeks up, 3 or 4 weeks up, and then another rollover in gold, which is very frustrating. That's what it looked like on a daily basis. But I would say that gold did rise. This closed at 1284, but gold did rise in aftermarket trading and was back close to 1310 on Saturday morning. So that is not, it didn't finish as bad as that particular candle looks like. Silver, by comparison, actually rose on Friday night. So silver, you can see clearly basing there. So silver starting to look a bit better. If we look at the GDX, bit of a mild decline, but really nothing too much to worry about. And if we look at this ratio between gold stocks and the gold price, you can see it's definitely better signs that that this decline. You can see the moving average has now flattened out. This ratio is now back above the moving average. So definite signs there that that we're to the bottom in gold stocks. So just to wrap up, just looking at things from a strategic point of view, the US market is off again. If we get a sharp rally from here, as I said, then we're likely to see an equally sharp pullback. So if we're at 1750 to 1780 within the next couple of weeks, then I would be looking to take a preemptive exit from the market. Excuse me, the best outcome would be for a gradual progressive rise through August. This is the ideal. I'm not saying we'll get this, but this is the ideal. A nice gradual rise through August, then we'd look at perhaps a 100 to 130 point pullback in September, and then we'd be back into a strong rally into the end of the year as we normally get. So that would be perfect. So let's wait and see how things pan out. And the very best stocks in the Australian market are still making good gains. So we're in a good period. It's really difficult to see anything much different over the next couple of years. At the moment, we seem to be set up for a continuation of what we've seen throughout this year. So if you're not participating and making money, then get in touch with me fairly quickly. That's it for this week. Cheers.